Alright guys, so this is Omni Industry Limited financial statement, or my look through at what is what. Alright. I was waiting on the financials to know how NCB did see that they're selling, and yeah, so we got to use that. So this is really just looking at the financial, and I'm just thinking whether or not they already participate, yes it oversubscribe and everything, but based on this whole persons who actually know if analyze stocks and themselves, they're going to look in the future. We're going to look at it. So the first thing is the summary. So they came up with a summary, and I just put it in Excel basically. So the full summary is this basically. So they give 5 years up to 2023. When they get the quarters. So there was that. Where to start? All right. So basically, we're going to just look at just the numbers, and we're really going to focus on the last two, which is 2021, 2023. Yeah, we're going to put them there, and the blue line that you're seeing right here, so is gross profit margin. Yeah, gross profit margin has been relatively consistent in the 24 range, 28 and 29.50 respectively for the last 2 years, which means their margin has been increasing ever so slightly. This is about I think 1.49% increase. Yeah. So basically this is millions of dollars basically. So this would be 591 million, and this is 602 million. So yeah, so as you can see, it's not like a major grow, but growth is growth regardless. But in a day, you have other expenses after gross, and they are over here. So really operating expenses and taxation and so on and so forth, finance costs. And then at the end, the net profit from the gross profit is 7.1%. And the year before it was 5.95%, which is small. It's small for manufacturing, but then again, manufacturing companies typically have smaller margins but higher amount. Normally, companies that are manufacturing typically have smaller margins. All right, that's just the game. It's just that they have a larger revenue for a smaller net profits. They really end up getting more dollar value per se. But for manufacturing companies, it's kind of small for um within the industry. So I want to show you guys still, but we're just going to go through financial as is. As you can see, one of the biggest things that you can see in this is a profit from operation has fallen marginally, but then what big also is that the profit from um finance costs, expenses that I'm up pay out, drastically fall. So that's why on here you see almost 50% it did fall by, which is also shown elsewhere. So that actually good. I think over the years their aim has been to reduce their liabilities, and it also shows on the DuPont analysis. It also shows on DuPont analysis. And as you can see, when you look at the liabilities, it's just been let me zoom up. I know some people look on them phone. So 602 mil, 558, then 549, 458, and 296. So really, I think they have been doubling down on this expense thing. Whenever NCB and them is, I say, oh, you need to drop this. So they have been doing it, and you're going to see the visual representation of what I'm saying. So I guess I'll show you. Look at the When you look at the revenue side, as you can see. So the revenue actually for this year has actually fallen a little bit. Not anything major, but any drop off a little bit. So from 2 billion 86 mil to 2 billion 39. So yeah, still the same margin percentage, but yeah, but at the end of the day, they still ended up growing the revenue by 2.3%. You see me? So compared to the year before, they grew the revenue like 2.3%. So that is fine. Still small, but fine. And I think one other main reason why this is the case is because I was really banking on the idea that they actually manufacture the PVC pipe, which consists of 51% of their actual earnings, but they don't. So that means they broke down their thing into three main areas: so wholesale, industrial, and construction. And these they control, which is about 49%, 49% of revenue them control. So that means that them can probably charge more. They can charge more or a higher margin on these items compared to other stuff because they make them in-house. But this, which is half of their revenue, means that they're buying from somewhere else. Means they don't have no advantage and they don't have no economy of scale. Economy of scale, when I say that, I mean relatively, they're buying in large quantities, so they get it cheaper. But the economy of scale I'm talking about is the sense of the fact that they're not like the person that manufactures, it means them can raise the price and sell it to other persons. The same place that they buy their pipes from, the competitor can also buy it. So that's the advantage that they don't have. And they say that it's been about 8 years since them start manufacture PVC pipes. But I think they should go into it. I guess maybe because it's easier and the capacity right now can't manage it because if this is industrial, which is 30%, and one company alone, which is Red Stripe, is covering almost 80% of the capacity, increasing, and maybe you're not going to see they're going back directly into PVC pipes right now. For a couple of years down the line, once they have increased and grow, and they start benefiting from the, less taxation, then yeah, if you start benefiting from less taxation, then they can reinvest back the money. Because really, what I've seen, the trend that I've seen, and you're going to see right now, I'm going to show you in the DuPont analysis, is that they have just been significantly dropping the debt, which is this. See, drastically they have been dropping it, which is good. So what going to happen is that they're going to have more capital to reinvest and so on and so forth. So that is good. That is good. Yeah, that is very good. Just reducing the debt. So this now, I know this can look color, but the grays are really the separation of, this is still their statement. I did not touch them, just work with what them doing. So basically, you see net cash from investing, you see money coming out of them account. This is good. This is good. If you see it red, this is good because this means that they're putting more money towards investing and I probably buying new equipment and so on and so forth. There is also cash and cash equivalent is also good because it was in the negatives for a minute and then it start increasing drastically. So that is also good. Also, the debt ratio, as I've been seeing, the debt ratio is what, 89, 86, 81, 74, and it's at 61. So they have been like literally going heavy on this whole debt reduction thing. All right, debt ratio just means how much of, how much debt you have that eat up your finances or eat up all the capital. So if it was at 89%, 86, 81, and just gradually fall, based on this, probably by next 2 or 3 years, they should be probably about like in the 40 or 30% region. And yeah, the gross profit margin has been relatively stagnant, but for the last 2 years, it go up, but then the margins have still been the same for a minute now. So then I don't think they're doing anything new. But I guess this is what happened when I show you the structure and you understand what is what. And then the operating expenses as a percentage of sales has been relatively the same. So that just means it's really a factor of the revenues and how they're getting their supply need for kind of fix up. So I already go through those stuff. Assets really, you can't really, the assets are fine. But there's one thing that I want to show you per se, and it's receivables. Receivables has increased, meaning persons have not been paying them, or at least some persons have not been paying them. So when you go through the financial statement, I end up seeing that that was one of their issues. But let me see if we can find it back. All right, so receivables, as you can see, it's a of trade receivable balance at the end of the year, approximately 45 million is due from the company's largest customer, which did not name. They never name them customer. Anyways, so there are no other customers who represent more than 9% of the total balance of receivables and da 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 da. So they also break down like, debt collection, how like who owe from 30 days, who owe over 90 days and so on and so forth, but that's not really what I want to see. All right, so with receivables, so here it is receivables. So it's a average credit period for a sale is between 30 to 60 days. Means roughly 2 months. Within 2 months after them give over them products, them get them money. Um, yeah, that's what it's saying. And then I said before accepting customers like credit, them have to do them assessment. However, what they're saying in the part here, so in the part it says in the company's trade receivable balance are debtors who are carrying amount of $41 million, which is past due. Means say it passes 60, it's pushing the 90, and means say oh it a push to 90. And they're saying it's a which is past due. But it's a but the company has not provided. So basically what they're saying is that it's past due. However, there's no significant changes to the customer or their customers credit quality. So basically them still now market off as bad debt yet. However, them don't really have no collateral or any credit enhancements over these balances. Means people them decide to them not pay, people it's not gonna pay. But I don't feel that's the case. I feel like them just they get for collect their money as it. So I just something they say and I guess, you know, felt to point that out. Outside of that, as I see anything we do with liabilities, even though over here so red means say oh it's been increasing or well it's been decreasing is good. Is it mean that's why I'm highlighting the green because it means say all of them debt and everything good. Them clear off bank overdraft, them do everything. So it is good. And as I say when you look on analysis you can see what is the driver. They have been significantly attacking their debt. So yeah. So as you can see the driver, which it really mean the drivers really know is just the return on assets. Means their assets are providing more. That's like the real driver. But they've also been heavily focusing on getting debt down. So that is good. So I'd say just give them a couple more years. Yeah, give them a couple more years and they should be fine. So now for the structure. And I talk about dividend policy. Dividend policy, they did say that they say if they get added to the market and so on and so forth, they would pay 25% of the net profit available for distribution after it has provided, it reserves and so on and so forth. Speaking of reserves, they also increase their reserves as well. So they significantly increase the reserves in the financials, just remind that. Yeah, so the retained earnings they have significantly increased almost 50%. Them increase it by. So there's that. But yeah, so basically they're saying 25% off them net profit after them do them thing and thing and thing. Me do the maths and essentially you can kinda expect the formula here, just it pull from the this are them the financial C165 is their net profit. So of them net profit or whatever, them potential payout at 25% would be on them 250 billion, them 2.5 billion dollar worth of shares. You're looking about a 1.56% dividend payout as it stands at the stock price at $1. So the price now going to reach $1. It's not gonna stay at $1. Um, yeah, very increase. So this percentage is definitely going to go down. So here is that. That's something we can keep in mind at. And also for the structure, the as you can see, you have one, two, three, four non-executive directors. And you want that in a company because they are persons that know would basically they rep the shareholders. You see me, they rep the shareholders. Because if you have a company that all exit like if Mr. Van White and everybody did have an interest in the company, mean like a monetary interest in the company being yeah. So if you have that then they'll be focusing more on company and them something there and not um shareholder value. So yeah. So you always want at least 70%, 60 to 70% of your executives being non non-executive means them not depend the board, them depend payroll and them things there. So one, two, three, four of six is good. And yes, this are really just recap in the sense that of the money that they're going to get, because remember the shareholders going to get their 250 mil back with themselves and the 235 mil that they get after expenses and everything. So they're going to their website and e-commerce platform because the platform is horrible. hands down. They going to the expansion, they more venture into Panama and so on and so forth. And they're also going like get new equipment. So that's really what they might use the money for. And they needed it in slow capital, which is that's why they really mean that's the real reason why they come to the market, because the debt, it's just too much basically. They just too much, so and it's too expensive. So getting shareholders is better, because at the end of the day, them can decide if they pay a dividend, retain all money. However, if it was debt, they want to get for them money first. So there is that. So now for the NCB thing, and a lot of persons worrying like, oh, NCB has sell out of the company and so on and so forth. That's not necessarily the case. Because if you look on the before invitation, NCB owns 7% of the company. Alright. And after the some shares after invitation, NCB own 3.5%, meaning they have sold out 5% of their shares and only for 3.5%. And then the lead broker pool is equivalent to 5% of the whole IPO thing. So I was waiting, as I said, but I wait for say what NCB do. So everybody's supposed to know them allocation already. Basically, the general public, what them have, everybody get them first 10,000 shares, and then they might get 25.49% of everything else after, which is not bad. And then now, for the lead broker reserve pool, they applied for 100%. So yeah, so if you check 5% here, so, and then the 3% here, so NTV essentially own 8.5% of the company. Before they own 7.5, and they own 8.5%. So there is that. Now for the last thing, which is my relative valuation analysis, and I'm kind of happy we did do this afterwards. Yeah. So it's the manufacturing industry for the junior market. These are all the competitors in the space. You have AMG Packaging, you have Blue Power, Consolidated Bakery, and so on and so forth. All right. So you have all them company here. Caribbean Fragrance, Honeyboard, and then Omni. So I sit down and do calculations myself, PE ratio, everything I do by myself already. You can check them if you want. So basically, at the end of the day, when you go to it, so for the PE, meaning their earning potential, they have a fair value of $1.21. When it comes to industry average for the book value, meaning what's on their books compared to what they're selling for, it is drastically smaller. Alright. And then you can see the industry average and so on and so forth. So the fair value based on the industry, remember relative valuation is not be all in all, it's just what's in the industry, and you're comparing it because it falls within the industry, is 61 cents. The share selling for $1. And even if we use the deviation at the positive rate, it's just $67. Meaning, say, may I give them the benefit of the doubt and add the 10%. And the 10% really just means, say, oh, I am basically nullifying all of the average and just I work with them off, because there's 10 in the industry. So yeah, 10 of them in this particular industry that we have can look on. So I'm just giving them the 10%. It's still 67. So I know Victoria Mutual say you could buy. Let me check. So yeah, so even though, alright, so we just add the analysis that they do to it. So my thing in relative valuation is 61 or 67 cents per dollar. Victoria Mutual says to participate. NTB evidently going to participate because of them thing. You can read through it. Might look through it and everything, but it's really just seeing what the IPO already say. So yeah. Anyways, and then fund managers says to do not participate because the estimated fair value is $1.08. I think this is discounted cash flow. Yeah, discounted cash flow fair value. So yeah, so do what you may mill. Do what with Do with it what you may will, or however them say that. But yeah, so is it really worth buying? I don't know. Talk to the financial advisor, but just come show numbers and so on and so forth. We can't tell whether that will participate. But yeah, so honestly, it's not really a bad company. I just feel like they probably just need maybe like a year or two for get them hoes in order. But yeah, that is all for now. So with that, guys, love you guys and catch you in the next video. So yeah, peace.